So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance. The U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
Tom Lee explains how stablecoins have quietly become a major force in global finance, now holding more U.S. treasuries than countries like Germany. With nearly 60% of stablecoin trading happening in Asia, they're strengthening dollar dominance globally. Their efficiency and profitability, especially platforms like Tether, are turning them into the backbone of a new financial system, with Bitcoin providing the trustless base that secures it all. Lee emphasizes that Bitcoin is evolving from a speculative asset to a strategic reserve, powering a parallel financial system. As companies like Amazon and Walmart explore their own stablecoins, and banks recognize blockchain's advantages, we're witnessing a shift in financial infrastructure. Stablecoins aren't just crypto tools, they're replacing core banking functions. This transformation also reflects in traditional markets. Lee points out that during times of uncertainty, credit spreads offer more accurate signals than economic forecasts. He believes we're entering a phase where crypto and traditional finance merge, with Bitcoin and stablecoins leading the change.
I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset. And companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. And then, but banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stablecoin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now, if you want to move billions and trillions, you just use the stablecoin market. And it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's not public.
How do you trust those Tether people? Like you don't really know what's going on.
Well, that's where, see, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code. Mm-hmm. And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world. So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you again model this out and utility, because remember stablecoins is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
Tom Lee explains that stablecoins now hold more U.S. treasuries than countries like Germany, boosting global dollar demand, especially in Asia. With platforms like Tether outperforming traditional banks, stablecoins are proving to be efficient, transparent financial tools. Bitcoin anchors this ecosystem, securing the blockchain and enabling the rise of Web3 finance. As companies like Amazon explore stablecoins, Lee believes we're entering a new era where crypto and traditional finance merge into a single, more efficient system.
You know, a lot of it is evidence-based because we do a lot of sensitivity analysis to try to understand where we are in markets. So a lot of our statements that we make are high probability statements. But for that to actually happen is luck, in a sense, right? Because something that has an 80% chance of happening doesn't prevent this being one of those 20% days that it doesn't happen. So, right, because let's see if something happens 90% of the time and it's happened a million times, but the next 3 times it doesn't happen. So like those 3 calls fail. Statistically, it's still going to stay at 90% for accumulated history. So like it is always risky to say something has a 90% chance of happening, but that's usually the reasons we make these kind of calls.
And just quickly, at a very high level. So when you're ready to say, okay, the S&P is going to jump and there's like an 80% chance that's going to happen, what signals are you pulling from? Like you said, you're looking at the sensitivities and different evidence.
Yeah. Well, a lot of times markets make big moves because of surprise. So we have to, like today, we're seeing it today with like Tesla. But the reason there's a surprise is that in a general sense, there's something that, let's say, anchors the valuation of a company. Let's say it's earnings or this S&P. Like, let's say that what anchors it is the Fed's dovish, okay? But then we worry about tariffs and recession. So, like, that's pulling down the market. You can always look for what will counter that argument of recession. And, like, for us this year, it was the high-yield market because high-yield spreads need to widen to, like, 800. The spread over treasuries has to be 800 basis points. So if the 10-year is at 4%, high yield would need to be at 12% to tell you that a recession is almost guaranteed. But high yield during the tariff turmoil only widened by 150 basis points or so, maybe 200, which is just a growth scare, if even. So the reason we stayed bullish into the April low was because high yield said the chance of recession is probably 10%, whereas the economists were saying it was 60%, and we could tell by positioning and what stocks were selling off. The S&P down 25% has priced in like a 60 or 70% chance of a recession. So that's how we can kind of go on and say the market could make a full recovery because high yield is telling us there's not a recession and it's a better economist than economists. So we do have a published history of our research, so our clients can fact check us. But as the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And, of course, everyone argued against it for logical reasons. They said tariffs, they're not going to be solved for a year, the Fed's not your friend. The Fed is going to – there's no liquidity coming like in 2020, so you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. The Fed liquidity is a myth. You don't need Fed liquidity for stocks to recover. I'd say that's really my takeaway from the bounce. And then for this week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasion. Well, so here it was our calculation, which I think maybe people would agree. The U.S. wouldn't take action if they thought it would daisy chain into a prolonged war, because there's no appetite. And Trump clearly said he doesn't want to pull us into a war. So if they're taking action, they've either signaled ahead to Iran that this is a limited action, or they know that whatever action they're taking is decisive and limited in scope. So that's why I could see why you would buy the invasion, right? And who knows? There's a lot of signs that maybe we did help indicate to Iran it's limited, because, Iran had the trucks and the U.S. was aware of all these trucks moving material, but they didn't stop it. So it was sort of like, look, we don't want to topple the regime necessarily, but we're going to blow this thing up. And I don't know. I'm not a political expert. I'm just saying I can understand why we're rallying today.
But Tom Lee explains how stablecoins are becoming powerful tools in global finance, now holding more U.S. treasuries than countries like Germany. Their growing use, especially in Asia, boosts dollar demand, while Bitcoin acts as the foundation that secures this system, shifting from speculation to real utility. He also points out that traditional signs of recession, like credit spreads, didn't confirm market fears during past sell-off. This shows how markets often overreact without real economic weakness. As big companies explore launching stablecoins, crypto is quickly becoming part of the mainstream financial system. Will stablecoins overtake traditional banks in the next decade? Is Bitcoin evolving into a true financial backbone, or still just a hedge? Share your thoughts in the comments.